when they're evaluating businesses, and how, as a business, you can prepare yourself for evaluation by investors. I will start with a round of introductions. My name is Nora Koigi, and I'm the director of the Deal Flow Facility at FSD Uganda. I am joined by my colleague Mercy, and I'll allow her to introduce herself.
Good morning, everyone. Thank you so much for joining us. My name is Mercy Manyeni. I am the investment officer at the Deal Flow Facility.
Thank you, Mercy. Given that we have quite a small audience, I think it's prudent to understand who we have on the call. So I'll ask you, Kenneth and Stella, to introduce yourselves.
Thank you very much. My name is Kenneth Kwesiga. I am the co-founder and CEO at IoTech Limited. And at IoTech, we are providing financial services and we regard ourselves as a fintech company.
Thank you, Kenneth. Stella?
Good morning. My name is Stella Lugalambi. I'm co-founder for Hamway East Africa.
Thank you, Stella. So how we will have our discussion this morning, or rather structure this discussion, is one, to give you an introduction of the Deal Flow Facility, so you understand where we're coming from in terms of being able to explain to you why businesses need to prepare themselves for investors. Then we will take you through the criteria that investors use, as well as then open up the field to questions. So what I would ask is that as we go, please write down your questions in the chat box, and then we will have a session at the end where we'll address all these questions. Is that okay?
Yes.
Thank you. So great. So Mercy, let's go to the first slide on the introduction to the DFF. Thank you. So the Deal Flow Facility is actually the brainchild of three institutions: the Capital Markets Authority of Uganda, FSD Uganda, and the EU, and it's actually funded by the EU. So what it is, in essence, it's a non-investing matchmaking facility that's incubated by FSD Uganda. What this means is that the DFF has no money of its own to invest. What we do have is a capacity building kitty where we work with enterprises, diagnose where their gaps are, provide some technical assistance, and then match them with investors. So really the objective of the Deal Flow Facility is to bridge the existing gap between investees, being enterprises, and private investors. So what we have understood and seen through studies is that enterprises struggle with access to finance, especially when you're looking at options outside of commercial banking finance. So the aim of the Deal Flow Facility is to increase access to alternative sources of finance for Ugandan businesses. So the key outputs that the Deal Flow Facility aims to achieve is to have a pipeline of investor-ready businesses. What this means is once we work with enterprises and get them through the process of technical assistance, at the end, we will really have a pipeline of businesses that are ready for investors. So investors can then come in and pick what they would like to invest in based on their specific mandates and interests. So we also aim to support, like I mentioned earlier, businesses through capacity building and advisory support. What this means is once we work with businesses, perform our light due diligence, and diagnose areas or gap areas that exist in the businesses, we then recommend technical assistance providers who then fill in the gap and help these businesses work through the gaps that we have identified together. Then once this is done, we'll now match them to potential investors. So the key stakeholders in the Deal Flow Facility process, outside from the three institutions I mentioned, is really Ugandan enterprises. And how we define Ugandan enterprises is businesses registered and operating in Uganda. Then, so those are the main stakeholders. Then secondly, we have investors who will then be investing in these transactions. And thirdly, we have intermediaries. And intermediaries are divided into three different classes, which we will discuss in detail a bit later. So the key outcomes that we envision is really increasing the number of deals, specifically around venture capital and private equity in the market. And we also want to increase the value of these deals in the Ugandan market. And what we also aim to achieve as a medium to long-term goal is seeing an increase in listings in the Ugandan Stock Exchange. So we envision that at least some of the businesses that we support over the next 5 years will get to IPO stage at some point in the future. And the impact metrics that we aim to achieve is increasing the levels of employment in Uganda, because we realize that SMEs really are the backbone of the Ugandan economy. So by supporting in SMEs to access finance and grow their businesses, directly and indirectly, we are supporting the increase of employment levels in Uganda. Then the deal flow facility being a 5-year project, we expect that throughout the project, the life of the project, we will pick key learnings, and some of them will point towards gaps in policy. So one of the impact aims we aim to achieve is actually to influence policy by pointing out the gaps that exist in regulation that would benefit the capital markets in Uganda by having these addressed by policymakers. Next slide. Great. So now this is really the journey that an enterprise would go through in the deal flow facility, from the point of application to the point of matching. So the first stage is that an application is made. You make an application, you fill in an online form that really tests the initial eligibility criteria, which is 3 criteria really. One is that it's a Ugandan business. Like I mentioned, a Ugandan business in our definition is a business that is registered and operating in Uganda. Secondly, we are looking at supporting businesses that have at least 2 years of audited statements. Thirdly, the third criteria is that we're looking at supporting businesses that are looking to raise at least $500,000. And this can be either debt or equity or a combination of these two. So this is the first check that the DFF does, which is check for the eligibility criteria based on these 3 criteria. Once we assess that a business fits these 3 criteria, we then progress them to the next stage, which is onboarding. And then at this point, we sign an NDA because we recognize that businesses are going to be sharing the information. So they need to have that level of comfort that the information will be used for the right and stated purpose. So once we receive the information from the enterprise, we then do a basic due diligence, which includes a site visit to the business, really just to ascertain that what the business states it's doing is what it's doing, because we also need to provide our investors with a level of confidence that we have done some of the legwork. So as part of the due diligence, we will then conduct what we call a business diagnostic test or analysis, which really analyzes the businesses from both qualitative and quantitative metrics. What this means is that we will go through the financials of this business to understand the financial performance as well as gaps and growth prospects of this business. Additionally, we will look at elements of the business that are not necessarily financial. For instance, the different operations of the different departments, as well as testing the risk processes and the governance and HR and finance and the key elements of this business that allow it to operate within its ecosystem. So at the end of this stage, what we generate is a business diagnostic report, which we then share with the SME in terms of sharing our findings and have a discussion with the SME on what our findings are, see whether the business actually understands where the gaps are. And once we agree that this is where the gaps are, then the SME signs off and we proceed to the recommended technical assistance. Because one of the key outputs of the business diagnostic report is really recommendations for technical assistance based on the gaps identified. Now, around technical assistance, we have 3 key types of technical assistance. One is the foundational technical assistance, 2 is thematic technical assistance, and 3 is specialized technical assistance. So for foundational TA, it is essentially a course on the basics of capital raising specifically to the Ugandan market. So what we look at here is really understanding what's available in the market, what instruments are there in the market, which investors are active, and what do they look for. Actually, this conversation we're having today is actually part of our foundational TA. So this is really prescribed for businesses that are at the very basic level of capital raising. So it helps them to understand what's available in the market and what they can do to position themselves to access what is available in the market. And this is conducted in-house by the deal flow facility team. Next, we have a thematic technical assistance, which is essentially filling in the gaps identified in our qualitative analysis. So I'll give you an example. For instance, if we come across a business that doesn't have a board at all, we will then recommend some technical assistance in which the topic will be corporate governance. So benefits of a board, how to construct a board, what to look for in a board, and really assist the business to the point where they actually have a board in place. So this is an example of what thematic technical assistance does. We identify the specific areas of need and design specific interventions to this for this thematic technical assistance. Now, this we do with our partner institutions. So we have several technical assistance partners who will then come in and do this thematic technical assistance. How this works is that we have a panel of providers, technical assistance providers, and the SME will be free to choose which technical assistance provider to use or to work with. What we will do as the deal flow facility team is have a guide, which we have already prepared, a guide on how to choose a technical assistance provider. Now, some of the elements of this guide includes understanding the past experience of this investor, looking at integrity issues of this investor. Are they well respected in the market? What experience do they have in this particular level of intervention? And it's really, the point of this is really to give the SME agency and empower the SME to pick their own technical assistance based on their own specified needs. The next level of technical assistance is specialized TA. So what this means is that we recognize that businesses may otherwise be investor ready, but may have some very specific TA needs that are the stumbling block between them and gaining investor money. And this is an area that we do not expect to happen often. It is one-off ad hoc TA that is highly specialized. For instance, if we're looking at a financial institution, say a microfinance lender, and they have a very shallow management information system, for instance, then we can come in and help them to actually improve their MIS and get to the point where they can achieve where the MIS is fit for purpose in terms of the size and function of this business. So this is just an example of some of the specialized TA that we plan to offer. And this will also be done in conjunction with the panel of intermediaries that we have. So after the companies go through the technical assistance and they sign off that they're happy with the technical assistance, they are then ready to match with investors. So at this point, we have two ways of matching with investors. One is that they get added, these enterprises get added to our database, our pipeline of investable businesses. And additionally, we have pitch days periodically where they can showcase their businesses to a panel of investors and then pick with whom they would like to work. Then at this stage, and once matches are made, we have a second level of intermediaries that then come in to ensure that we get from the point of matchmaking to deal closure. And these are transaction support intermediaries. An example here would be your lawyers, accountants, and business analysts and the like. So the point here is to make sure that businesses actually understand transactions that they're getting into, understand the legality of it, and what the agreements say, and ensure that a business is really able to get to the point where they close the deal. So this is really, in a nutshell, the investment journey in the deal flow facility. Next slide. Yes, so that is a brief of the deal flow facility and what we offer. And if you have any questions, please add them to the chat box and we will address them at the end. So I will hand over to my colleague, Mercy, who will take us through the criteria investors use when they're evaluating companies. Thank you.
Thank you so much, Nora. And I see Ronald has joined us, so maybe we can just give him 1 minute to introduce himself. Ronald. Okay. Yeah, okay. I guess when he's ready, he will do that. But thank you so much, everyone, for joining this call this morning. We will be looking at some of the criteria that the investors would be evaluating, and really this is from our own experience working with different investors that deploy capital within East Africa, and also based on the experiences of the investors that you're trying to pull into the DFF as well. So some of this are actually the factors or levers that they'll be evaluating in a business. So and I think it's also important to actually, before we even delve into it, it's important to actually understand how a PE structure would look like. And I'm sure since most of you are entrepreneurs and SMEs on the call, then I think this is something important to understand. So ideally, a PE would get their own money from, say, a limited partner, an LP, and then, a general partner would then be deploying that capital into different PE funds, and then and managing that as well actively. And then the PE would get sort of a management fee, usually about 2%, and then a performance-based fee, meaning they would share, a certain percentage on the profits of any investment that is made. So really, and the reason I'm bringing this up is so that what drives the PE when or a commercial investor when they're actually making investment is actually profits, because ultimately they'll share into the profits. So what a commercial investor would then be looking to evaluate within a business is what are the levers of that company that would actually ensure that the business actually makes profit or is actually profitable, so that at the point of exit, they're able to make profit. And remember, different investors have different lives in terms of when they hold an investment within a firm. So some between 7 to 10 years, and others are evergreen as well. So the reason why they would want to evaluate that is, of course, so that at the point of exit, then they can make a profit. So based on our own experience, we've bucketed all the criteria that they'll be looking at into 4. So that's the business operation, they'll evaluate the business model and operation model, they'll evaluate your team and governance, they'll also evaluate your financials and the overall organizational structure, and how that ensures that the company actually is working as a well-oiled machine. So within different thematic areas, there's sub-themes that we have identified, and we'll be looking at this one by one in subsequent slides. But it's important to also note that whereas these are the general levels that a potential investor would be evaluating, there is different criteria depending on the investor's objective that they would also add into the metrics that they actually evaluate. And a good example here is, say, for an impact investor. Other than the 4 theme areas that we've identified, an impact investor would then go in and evaluate impact metrics. Things like how does this company create jobs, how is it say reducing the carbon footprint globally, and any other impact metrics that they may have around environmental, social governance. Another example could be, say, an earlier stage investor, meaning a VC. If they come in, they would also want to evaluate a team more, and how that the vision of the team versus the rest of the factors of the team. And something important to note here as well is that different investors have different risk profiles and risk appetite. So they may put more weighting into some metrics than other metrics as well. So yeah, so I think we'll move into the first, which is the business and operating model evaluation. And how we'll tackle this is we'll be looking at this from both an investor lens and then what you as an entrepreneur can actually do to ensure that you meet that criteria in terms of what the investor is looking for. So under market evaluation, there's obviously the first one which an investor would be looking at is the market sizing. And market sizing here, they'll be looking at what your total addressable market is, what your share of the market is. And I'm hoping, given that we are all seasoned, or rather most of us are seasoned entrepreneurs on the call, then this is something you've already calculated and are doing or have an idea of. And if not, then again, we as the DFF are here again to support you with that journey, and we can provide you tools to ensure that you actually size your market correctly. But what we wanted to focus on for this particular call is from an investor's perspective, then they'll be looking at both external risks and internal factors that are driven by the company from a market analysis point of view. So if you look at the right side of your screen, a potential investor would then be looking to evaluate your company in terms of the pastel risks that are there. So that's the political and around political, they'd be assessing how susceptible your company is to any political risks in terms of which government of the day is your company actually susceptible to the government of the day, meaning any policies that are being carried, etc. And how are you a politically exposed business or a politically exposed person as well. Then there's economical. Again, the criteria that they'll be looking at here is, for instance, forex, and particularly if, say, you're an exporting company, they'll be looking at how susceptible are you when it comes to forex, inflation, etc. Social as well. For instance, they'll be looking at any social or cultural factors that may affect your business. And keep in mind, again, different investors have different risk appetites. And so depending on the risk appetite of the investor, then, a potential investor would say, well, I'd want to invest in you, versus another would say, because of that risk exposure, then I'm not willing to take that risk for my funds. Similarly, they'll be looking at technological, how fast-paced is the technology within your industry. For instance, I hear, Kenneth, you mentioned your around IO tech, so fintech. So how fast-paced is that industry? What are the new changes that are coming up, and how would that affect the running of the business? And then around environmental and legal as well, where they'll be looking at any regulatory overhangs within that industry. So, and for instance, here I can give an example of fintechs around, say, cryptocurrency. Some of the the governments of the day have not necessarily adopted regulation that would support cryptocurrency, although that's happening to some extent, but they haven't yet got there. So if you're a company that's actually in crypto, how does that then affect the risk of the business? So those are some of the external things that the investor would evaluate. And of course, as DFF, we are happy to share with you a pastel tool that can actually help you sort of feeling, how your pastel looks like. Then internally, they'd be evaluating your market around how's your industry positioned, how competitive is the industry versus how does your customer segment look like. And so if we take this one by one, we'll start with we'll start with industry positioning. What we mean here is, where's your company located, or how's your company placed within a particular industry? And a good tool here that we see is the Porter's model. Usually, the Porter's model is actually a model that was developed by a professor from Harvard, Michael Porter, and it's usually it assumes 5 forces that drives the market. And why is this important for you to understand? understand, it's because it can actually help you develop different strategies to actually mitigate your competition. And this is really from an investee point of view. So for instance, the model assumes, say we begin with threat of new entrants. If your market or if your industry is quite susceptible to people or other players coming into the market, then it means you really have low market entry barriers. And so if anyone can start, a company in your industry or in your market, then it means that market or industry is highly, highly competitive. So then what does that say to you? So from an investor's perspective, they'll then be evaluating, how strong is your USP, your unique selling proposition? How strong is the value proposition such that you're able to mitigate any threats or the effects of low market entry barriers? If you look at something like the threat of new substitute products, an investor would ideally look at, okay, so you're selling, or you have a B2B platform that distributes fresh vegetables, for instance. So an investor would then look at, okay, so in a market like Uganda, how easy is it for people to pick up that model versus people going, into the market and buying fresh produce? So they'd assess that and then ask you, what are your mitigation strategies along that? And then based on that, or based on the value proposition that you built for the company, then they can be able to either assess their risk appetite for investing in that company. Then there is the bargaining power of suppliers. And really here is within your industry or within your market, how many suppliers, particularly of raw material, are there? Because the less number of suppliers, it means the high cost of the raw material, and that then means either you sell at a higher price, and that would affect the purchasing power of your customer, or you make a smaller profit margin, which again affects the revenue margins of a company. So again, how are you able to develop strategies as an investee or entrepreneur to actually mitigate that? And some of the strategies that we've seen other people employ is something like they then look for alternative sources of where to get different materials that is cheaper, of course, or optimized, etc. Then lastly, there's the bargaining power of customers, or how many customers are within your market segment. So for instance, if you are targeting a very, very niche market segment and where there are fewer customers, then there is a likelihood that they have more power in terms of bargain, and that could actually reflect on your pricing because you're targeting a very niche market. So again, these four are for you as an investee to actually develop strategies to mitigate against, but from an investor's perspective, then also try to understand how the industry looks like from all these four forces. And lastly, the fifth force is really around competition. And I'm sure, given that most of us are entrepreneurs on the call, then this is something that we've already analyzed and assessed. And I think what we see mostly is most entrepreneurs, investees focus on the direct competitors and indirect competitors, but most of us either forget or assume the future competition that we may face. So I just want to simply focus around the future competition and how that looks like. So future competition really is if there's any other competitor in the market that has the potential to enter your market but haven't done so for one reason or the other. And here I can give a fintech example. If for instance in the fintech space, you've developed products, but your USP, unique selling proposition, is a bit low, and so an MTN, for instance, or an Airtel can actually come in and either replicate the same model that you're having, then that poses a big risk in terms of competition. And that would affect how bullish or bearish your market could be in the future. So in the beginning, you want to actually develop strategies that can actually help you mitigate against that, or you could actually consider working in partnership with them, so that at the point it becomes sort of one of your exit strategies, which we are going to talk about below, where then you can say, well, I'm willing to partner with you, either we merge or you can buy me out, etc, etc. So that's the one thing that we really wanted for us to focus on. And again, this is something that we can provide a tool for you, so that you can be able to sort of map out, your competition within the SWOT. I'm sure every one of us has heard about the SWOT analysis. So really here, it's then how do you analyze your competitor using SWOT? How strong is their brand presence? What distribution methods are they using? Are there new markets they want to enter into? Is there cross-selling that's happening? So it's really for you to understand from that perspective as an investee. But from an investor's point of view, they also want to understand this. And it's important for you to have some of these tools ready to go. We've seen some of this merged within the business plan. Some of this are merged within the investment memo or teaser deck. But really, it's important for you to understand this from an investee point of view, because it's obviously going to come up in an investor conversation. Right. So the other thing that would be looking to evaluate is around scale. How efficient or how fast can the company scale at a very optimized cost? And the reason that we're looking at this, and as I began by saying, is really because they want to understand what's the profitability that the company can make at the point of exit of their investment. So, and I'll look at this from an investee angle. So there's different strategies we could employ to actually scale. I'm assuming some of us are either at the point of thinking about growth or thinking about scale. So how then do you scale? There's two ways that we've seen different entrepreneurs or companies scaling. Either you can scale deep or you can scale out. And scaling deep is really focusing on the niche on the niche product. So adding, refining your product until you become niche and known within that specific market. Whereas scaling out is adding different products within your company to actually have a bigger product mix. And there's different pros and cons to each, and I'm sure we'll share this slide with you much later, so that you can just read through, you can read through the different pros, cons, and characteristics of each type of scale. So there's really not one size fits all in terms of what scaling method you would choose to apply or implement, but it really depends with your company. And a good tool for you to use to assess how or what strategy you can take advantage of is the Ansoff matrix. Again, this is a tool that we can provide you, and the Ansoff matrix means, or rather says that there's 4 different ways in which you can scale your company or scale your product, different strategies. So either you could choose to do a market penetration, or you could diversify, or you could do market development, or you could do product development. So these are the 4 strategies that you can utilize, and each of these strategies have different risk profiles. So for instance, the lowest risk is the market penetration, and that is the first quadrant on the left side. That's a low risk. So say for instance, and there's different strategies within market penetration that you can take advantage of. So for instance, say you're scaling your product from, I know Hamwe you have an East African view. So say you're scaling your product to Rwanda, or your services to Rwanda. And so market penetration could be, if you're going into Rwanda, then you price your service or product slightly lower than you would in Uganda, just to ensure that you actually get a bigger, a bigger market. You get a bigger market, and then once you ensure you have a loyal market, then you can start increasing the price gradually until you get to cost. So that's one strategy you could use. The other strategy is you increase your promotion and marketing efforts so that you actually attract new customers to your services or products, or you could place or distribute your products, using different ways. Say, take advantage of any e-commerce platforms, or take advantage of any other new segments that are arising. The next is market development, which is really medium risk. And again, here there's different strategies that you could utilize. Either you expand your footprint geographically, say move from Kampala to northern Uganda. So basically geographical expansion. Then you could attract non-users. Say you're operating within Kampala, but only a specific segment is buying into your product or service, then you could attract non-users into buying the product or service, etc. Similarly, for diversification, where there's different methods of diversification, and product development, where there's different strategies for product development. All these four have different risk levels, and so whichever you choose, it depends again with your as an investee, depends with your risk profile. And again, this slide will be available to you so that you can just read through each of the risk profile. But from an investor's perspective, then they would want to analyze, okay, so you're looking to do geographical expansion, how much would that cost? How easy is it to replicate the model, in terms of is it CapEx intensive? By CapEx intensive, I mean, would you require an office, land to buy? What do you require? Or is it very CapEx light? And so depending on the risk appetite as well, then they can choose to either deploy or not deploy within your company. Right. Then lastly, around the business and operation model is the possible exit routes that can be taken up. So ideally, this is quite important for an investor to actually understand, particularly in the beginning, before they even sign the deal. So they want to understand, okay, for this particular company, how would our exit route look like? Will we do a secondary sale or a strategic sale? And that's mostly informed by who are the other players in the market. And so a secondary or strategic sale really would involve, the current investors, selling their shares to another third party, either an aligned investor or any other strategic partner within the market. And I think some of this exits have happened in Uganda, and maybe most of you could maybe relate to the Actis exit from the Umeme Limited. So the exit, I think, happened in 2016, if I'm not mistaken, but Actis had held their funds in Umeme for about 11 years or so, and then they sold it to NSSF. So that's one of the exit strategies that can take place. There's promoter buyback, where then you as the promoter or investee says, well, I want to buy back the shares that the investor had taken, and of course you buy it at a premium. And again, much later we look at how do you negotiate things, how do you negotiate some of these things in the term sheet, what premium it would be, do you have the right of the investor coming to you to first sell the shares to you or not? So some of these things we'll tackle much later in our subsequent curricula. Then there's the mergers and acquisition, where different merging and acquisition will happen. And again, this is something within East Africa particularly, this is something that we've seen gain more traction over the years, and a lot of M&As are actually happening. But it actually involves consolidating the investee company with another company that is strategic, of course. And then lastly, it's the IPO, initial public offering. So this usually either you exit through a stock exchange, say for instance the USE. It's the most rarely used within Africa. However, we've actually started to see again traction on this. And for instance, the Jumia one that was listed you know, as an IPO exit route. So yeah, however, there are different advantages and disadvantages to this. And I think down the line, we'll also have someone from CMA come in to just talk to us about, you know, what does that mean? What are the things we need to be prepared for if we are exiting through an IPO, particularly yeah, and what are the risks? What can we prepare ourselves for? But just to take you through some of the advantages of an IPO, I think it's the most profitable of the exit routes because you're actually you know, listing your company publicly, and then you can actually restructure your balance sheet, meaning you can refinance, and then it also gives you like a prestige brand name because you've been listed in the USC or NSE, yeah, whichever stock exchange you use to actually list. Right, so that's about the business and operating model. And then the second thing or theme area that we'll be looking at is around your team and corporate governance. And please feel free to type any of your questions on the chat box. I know I'm running through this a bit quick, but yeah, please feel free to chat, you know, to put any questions in the chat box. So yeah, so around the team, ideally a commercial investor would be looking at, you know, evaluating how the corporate governance structures looks like within the company. And really here, it's to see, you know, particularly this we see for family, you know, family-owned businesses, and it's actually to just understand what are the risks that they can expect within, you know, if they invest in a company and invest in that team. So for instance, they'll be looking at, you know, your board, what does that consist? Some of these investors also would take boardship rights. So meaning they'd actually sit on your board once they invest, and they would want to understand, okay, so who are the other members of the board? Is there an oversight for the board? Like to what extent are they providing oversight, and are they providing advisory? Are there, you know, adequate disclosures? You know, any risk factors that they may actually face, and are there any risk management processes, because that would actually, you know, give them comfort in terms of where you know, where the investment is being made. And lastly, equitable treatment. Again, we'll share the slides with you so you can just have a quick read through them. But what we want to insist on is really, some of us focus on the technical skills, but forget the softer skills or the non-technical skills. So that could be, you know, integrity and honesty, adaptability, interpersonal. Particularly for adaptability, we saw this more so during COVID, you know, where different teams that were able to adapt, you know, actually, you know, they actually survived the COVID period where there was a lot of lockdown. So different, you know, BCPs, meaning business continuity plans, were, you know, what took effect during COVID. Because now supply chains have been cut short or cut off because of, you know, lockdowns. So what does a company do? Different customers are not able to come and purchase service directly. So what does a company do? So teams that were actually adaptable actually survived, you know, or companies that are adaptable actually survived the pandemic. But yeah, these are some of the softer skills that a, you know, potential investor would evaluate. And then lastly, we do have financials, which is the most critical, particularly from an investor lens. What they would want to understand is, so they would want to understand it in 3 ways, or analyze it in 3 ways. So first of all, you know, your horizontal, and that's sort of a trend analysis that's done across different accounting periods. So say, how have you been growing year on year, or how have you been growing month on month, etc. So they would want to also look at that, and that's the reason they would actually ask you for historical financials. And as you realize, as part of DFF, we're actually looking for companies that have at least 2 years of audited statements. So again, this is just to help them analyze the financials of a company horizontally and how you've been growing, to measure the efficiency, whether that has increased or decreased, etc. They also want to understand the company from a vertical analysis point of view, where they would compare a different line item within the profit and loss statement or balance sheet compared to another line item, to understand to what extent it contributes to the revenue, etc. So for instance, say salaries, which is like one of the biggest costs companies usually have. So they would want to understand, okay, what percentage of the salaries is actually of the revenue is salaries, and to what extent will that affect the margins that you're making as a company, either on a gross level or an EBITDA level or net level. So again, that's something that they would want to compare and understand. And then lastly, and most important, is the ratio analysis, and different investors would look at different ratio analysis. Again, we'll share this with you because these are just some of the formulas that you can actually utilize to incorporate in your financial model, to actually understand the ratios that are there, or the ratios that would be analyzed, and different ratios, for instance, profitability ratios, leverage ratios, liquidity ratios as well, etc. So usually they look at an EBITDA margin. What margin are you making? Is it increasing? And if it's decreasing, what's the reason? Are there any red flags on that EBITDA margin? Of course, the higher the margin, the better, for particularly on profitability ratios, the better for from an investor's point of view. So yeah, and then leverage ratios, particularly how have you been repaying your debt? If you've taken any commercial debt financing, how have you been repaying that? To what extent is it affecting your cash flows in terms of repayment, etc. Important to note here that any debt that you have in your books should not necessarily strain your cash flows, and it's really based on a sector to sector, from a sector to sector lens or industry to industry lens. And what I mean there is some industries are more prone to take debt to actually finance either their working capital, to finance some of their capex purchase as well. So some industries you'd find have a huge, take up huge debt, but it's the nature of the industry. So investors would ideally look at it from that angle and see, well, this is an industry where I expect higher ratios, higher debt ratios compared to any other. And then liquidity ratios, efficiency ratios as well. And then lastly, rates of return or return analysis, meaning what's the return on investment that they would ideally take or ideally have. And this actually is both from your historical financials and projected financials as well. So it's just not, one side of the coin, but it's using your historical to actually, assess your future and how that future looks like. Yeah, so, and on that note, given that I've said you also need your financial projections, this is just a summary of how, a financial model would look like. And I'm sure most of you on the call have a financial model, at least something, or projections, and usually this is just a diagrammatic view to just help you understand how different aspects of different aspects or line items in a financial statement would contribute to the financial model, and how that interacts. Because usually what we want is a model that is fully integrated, such that if you change one thing in a model, it affects it affects the whole model. And so this is something, it's a tool that is dynamic, so an entrepreneur needs to keep updating it as different scenarios come up and as different things change within the business. Again, this is something we could share with you so that you can just have a quick read through, and also try and understand whether you've completely modeled your financials. And then lastly, these are the tips from a financial modeling perspective. I know some of us usually say, well, but I have a financial expert, or I have a CFO. that's their purview. It's not my purview as a founder or co-founder. But from when you're having conversations with investors, then this is something even you as a co-founder of your business at least needs to have a general idea of. So sometimes, we have conversations with entrepreneurs and you ask them, well, but what has been your margin looking like? What have been your margins looking like? And then they say, well, let me go confirm. Or you ask them, okay, so what's your top line revenue for last year? They're like, oh, I'm not quite sure, let me go confirm. At least these are things, if you're having investor conversations, you should be able to have, particularly if you're founder. And then when it comes to details and whatnot, then you can reference or refer that to the CFO, etc. But at least the top line revenue, your margins, these are things you should be able to know and understand as an entrepreneur. So these are the different tips of how to develop a very good or integrated financial model. And again, these are tips that you can just read through and ensure that your models are actually following some of these tips, if not all. Yeah, so I'll stop there. And if there are any questions, please feel free to put them in the chat, but I'll stop there and hand over the mic to Nora.
Thank you, Mercy, for the detailed presentation. We'll go into questions. Kenneth, I see a few questions from you, so we'll go through them one by one. The first question from Kenneth says, we are yet to make 2 years since our incorporation as a company. Given that we do not have 2 years of audited books of records, would this be a showstopper? So my question to you, Kenneth, is how long will it be till you make 2 years? When do you make 2 years?
Hi, I think it's my colleague on the other line, Simon, who is using my account, but I'll still answer the question. We make 2 years in February, I think February next year. We should be making 2 years, 2022.
Okay, so
yeah, February 18th, to be exact.
Great. So do you have audited statements for 2020?
Yes, we do.
Okay, so then you will also audit your 2021 financials.
Yes, absolutely.
Okay, so my answer to you then would be that it would not be a showstopper. We can already start to work with you. However, please note that the criteria is strictly 2 years of audited statements. What we do have for you in the meantime is that you can access all the knowledge sharing material that we have, including the foundational technical assistance course, while we then wait for you to actually have the 2 years of audited statements, which should happen really in the next 3 months, correct?
Yeah, that's correct.
Yes. So the DFF is a 5-year program. So I think 2-3 months in the grand scheme of things is not very long to wait. However, like I mentioned, you can still start applying and you can still start accessing the initial knowledge sharing material that we have. So I think that answers your second question, which is when and how can we start applying to the DFF? Like I mentioned, you can already start to apply, and then we will keep you informed with our knowledge sharing material, including the foundational technical assistance, as well as any webinars and masterclasses we have in the future. And then when you do qualify, then you can be onboarded as a DFF partner. And the next question from Simon is, given that we are not at the TA level yet, what actionable advice can you provide for us to start getting ready? These slides, the video recording, additional content from your resource library. So I think I've also tackled this as well. So we do have the foundational technical assistance, which is a full course, of which this is just a small excerpt. So that will be accessible to you as well as any other resources we have in our library. And the library is an ongoing and dynamic effort that we will constantly upload and update with any knowledge sharing material that we come up with. Next question is, are there any costs involved for the enterprise in participating in the deal flow facility? The answer here is no. There is no application fee or cost element to joining and being a partner in the deal flow facility. However, when it comes to technical assistance, there is a cost share element with the enterprise, where the deal flow facility will pay for a portion of the technical assistance and the company will pay for a portion of the technical assistance. So there's a cost sharing at that element. However, for joining the technical assistance facility, there is no cost involved. Last question from Simon is, what is the typical ticket size the investors will be looking to invest? So this is tied to our eligibility criteria, where we're looking to support businesses that are raising at least $500,000. So in line with that, we are working with investors whose ticket sizes are $500,000 and above. So there is no upper limit in terms of ticket size. However, the base is $500,000. Any other questions or follow-ups?
No, not really. Thank you, Nora. And I think you answered the questions quite well. Thank you.
Thank you, Simon. Any questions, Stella?
No, this was very interesting. Are you sharing the presentation? Because there were several things that I want to go through that I even never knew, which would be very interesting to go through if possible.
Yes, we shall share the presentation with the participants after this.
And since you will share your emails as well, so I can ask more questions after I go through this, because it was, I was just grasping everything. I didn't think of asking, but I was listening in to everything since it was a nice and early.
Okay, good. Yes,
Yeah.
so you can send us any questions or comments you may have through the email address on the screen, which is dff@fsduganda.or.ug. So this is also part of the presentation, so you'll see that.
Okay, thank you so much. Hamwe has been in business for 8 years, and so it would be nice to try and get an investor on board.
Absolutely, we are happy to have you on board, and we will let you know what the application process is. So what we are doing currently is running, as a deal flow facility, is running a short closed pilot with a small number of enterprises, the purpose of which really is to test our processes and our tools and the operating model that we have proposed, with the aim of launching officially in January. So we will invite you to apply as Hamwe and as IoTech in January once we open the applications up.
Thank you so much. Yes, I would be looking forward to that.
Great.
I do have a follow-up question. I see that most of the presentation is inclined towards getting the company's investor ready and making sure that we are, ready for investors. My question or request for information is also now geared towards the reverse. As fintechs and as companies that are seeking for investment, we are also very keen on making sure we get the right investors, because I'm pretty sure not all investors that are out there are perfect or a good match. Is there a way, or is there information, or is there a way this deal flow facility can also help us, identify good investors, some sort of metric that we can follow to basically give back power to us, in the sense that we choose the investor and the investor doesn't choose us. That's the best way I can put it. Yeah.
Yeah, and thank you for that great question, Kenneth. And this is indeed part of the course on foundational technical assistance. So like I mentioned, the format of this webinar is really a series of 1-hour sessions like this, where we break down the foundational technical assistance curriculum in a process manner. So this particular section was on how to be attractive to investors, but we have a subsequent section on how to pick the right investor. So this is also part of our foundational technical assistance. So we will also share the invite for that once if we get to that point. Additionally, when you join the deal flow facility, make your application and you join, then you will have access to the entire course, which includes your question on how to pick the right investor.
Thank you. I appreciate it. I look forward to that.
Good. Great. Thank you very much for this session. It was very helpful, and it was particularly useful for us for it to be interactive and to hear your feedback. So we are very grateful for that. And we look forward to having you as part of the Deal Flow facility and to interacting with you in future knowledge sharing sessions. Thank you very much.
Thank you. Have a nice day.
Have a good day.
All right. Bye-bye.
Bye.